PCD webinar on non-extractive finance, a better way to invest sustainably. Over the last 2 years, we've done a huge amount of content on ESG and sustainable investment trends. Today, we're going to challenge the wealth management industry, the investment industry that is often supporting clients who want to invest more sustainably. I'm joined by three experts who I'm delighted to bring into the conversation very shortly. But as always with PCD content, we love to get comments from our viewers as we move along live. Please do put a comment in the chat. I'll be able to see that and I'll bring them straight to our panelists as we move through the session. So looking forward to a really interesting conversation today. Delighted to welcome back Rennie Hoare, partner and head of philanthropy at Hoare in London. Rennie, nice to see you again. Be interesting to, first of all, just hear a little bit about your interest and passion for sustainable investing.
Yeah, so certainly it's something that goes back over a decade. So at university, I was studying politics, certainly with no desire to be a politician, but focusing in on environmental politics and the way that shapes the system that we live in now. My dissertation was on wind farms and why a local area rejected them. And out of university, went into asset management. The first job I was in, there was an alternative energy investment fund. And so understanding how you can be putting money to use to start changing systems and solve these big problems was really exciting. So spent 7 years in asset management, also at T. Rowe Price, where I helped to be part of a team that rewrote their ESG policy statement. And then on landing up at Hoare's Bank, there's been a lot around the way that we think about sustainability. One of the main vehicles for that is our charitable trust that sits alongside the bank, and come around to later.
Fantastic. Well, look, great to have you with us today, Rennie, in your perspective. Next up, Melanie Ryback, who's a CEO and co-founder of Non-Profit Ventures. Melanie, you're very passionate about this idea of non-extractive finance. Perhaps you could explain us a little bit more.
Sure. So in either case, just to introduce myself first. I'm an entrepreneur, and I'm also an expert in nonprofit and steward ownership business models. So I'm actually running a cybersecurity company called Radically Open Security, which donates 90% of its profits to charity. So it's kind of flipping philanthropy on its head, which is typically you earn the money first and then you give it away. I'm using a structure where the giving it away is actually built into the core of the business. So, and I've also been running Non-Profit Ventures, which is a business incubator, and we've incubated almost 50 startups to help them to use these similar nonprofit, steward-owned and cross-subsidization models. And I've also been getting increasingly into finance. I'm actually also coming at this from the point of an educator, because I've also created the post-growth entrepreneurship class at the University of Amsterdam. That's launching this January. 120 students have enrolled. It's full. It's at the enrollment cap. And part of what I'm very interested in is how we can reform the finance field to make it less extractive, so we can change the fundamental incentive structures to get different outcomes.
Fantastic. Well, I look forward to getting into a bit more detail, but great to have an entrepreneur on the panel with such passion for this subject and showing others how it can be done, how it can be possible. So terrific to have you with us today, Melanie. Last but not least, Daniela Barone Suarez, from CEO of Snowball Impact Investments. Welcome, Daniela.
Thank you. Thank you.
Nice to have you on today.
Pleasure. My pleasure. Well, I think just as an introduction, I spent the first 10 years of my career in banking and private equity investing in Brazil, the US, the UK, and Europe. And for over 15 years, I moved to impact investing. And it's interesting because like Rennie, or even before that, I grew up in Brazil, and I seen poverty in my childhood a lot. And rather than living in a bubble, I decided to engage with it. And from a very young age, I always had an interest in thinking about ways of resolving inequality, poverty, and injustice. And my career took several different meanders until I finally landed where I am. And so in addition of being CEO of Snowball, I'm also a non-executive director at Intercontinental Hotels Group, PLC, and a trustee for the Institute of the Future of Work and a senior advisor for the Forward Institute. But I joined Snowball Impact Investments because I think I'm part of a group of investors who believe we can do better than we've been doing in investing. When we think about finance and the topic of today, finance is the oil of an economy, and it should act to create prosperity for everyone in the broadest sense. But the current financial system outsources that to government and operates in a vacuum largely, as if social and environmental issues are none of their concern. So what we've created at Snowball is a better way. It's a way that we can invest in a way that is consistent with planetary boundaries and in a way that creates prosperity for all and nurtures a healthier economy. So our belief overall is that investment is a really powerful lever for change. And the way that we affect this change is by doing it in practice, by being an example of what can be done. So what makes us unique in terms of being an investment manager is that in our portfolio, you will find investments that are making risk-adjusted market returns, but they're also solving problems for people and planet. As an investor, in a way, we invest in what actually is a good investment, right? So we invest in focused, mission-driven businesses that are solving some of the biggest social and environmental issues we face, which ultimately buy in a selection of funds and companies that are the future. Right? So the investment case is the impact case. And what we will posit today, what I will posit today in this conversation is that true non-extractive finance is actually better finance.
Fantastic. Well, look, great to have you with us. Really looking forward to the hour ahead. Melanie, you mentioned that you've been looking at not only the wealth management sector, but private equity and analysing it from an industry outsider perspective and looking at the business models and perhaps the conflict of interest that is also thrown up in there. Perhaps you could set out how you see the wealth management and the private equity industries, how they're doing on this journey towards sustainable investment solutions for clients.
Yes. So I think if you look at the current private equity industry, but also impact investment, ESG as a whole, we're reaching a crossroads. I'm sure it hasn't escaped anybody's attention what's been happening recently in the United States, particularly in Texas, but also, West Virginia, Florida. There's a movement right now that's spreading that's basically the so-called woke finance movement, right? And really what they're doing is they're calling into question, of course, whether or not ESG is responsible in a fiduciary way. And on top of that, they're really calling into question the greenwashing that has been embedded into ESG for so long. Now, the funny thing is, I decided just for giggles, to read Woke Incorporated by the fund manager who started Strive Asset Management. And the really funny thing is his book, minus the very right-wing perspective, is almost the same thing as Winners Take All from Anand Giridharadas, who's also talking about the greenwashing. It's just that, of course, in my perspective, Woke Incorporated is sort of conflating stakeholder capitalism with greenwashing. Obviously, they're not the same thing. But both books actually, despite one coming from an extremely progressive left point of view and another one coming from an extremely progressive, an extremely far to the right point of view, where they're meeting is the fact that there's actually too much financial extraction that's happening from the things that we're calling social and environmentally responsible. Now, if you look at the economy as a whole, there is a tremendous amount of extraction that's happening. And there's two places this comes from. One is through businesses, and we tend to see this mostly with liquidation events of companies. So particularly IPOs and acquisitions, a lot of value is pulled out of the company and oftentimes leaving the company dysfunctional. And the second place where this capital is extracted is in finance, and this is mostly through fee structures. If you consider the standard 2 and 20, that's pretty much ubiquitous throughout the investment industry. The problem here, of course, is that 20% carried interest embeds the growth imperative into startups. It's the reason why, if I want to start a company and I go to a local incubator, on day one, they're going to push a PowerPoint slide in front of my nose with an exponential curve on it and say, yeah, do this, which of course, if you dissect, the only real purpose for this is to reach the exit in 3 to 5 years. Similarly, also, the 2% is mega extractive. I mean, of course, you just have to remember John Bogle, who constantly spoke about the tyranny of the fees and the conflict of interest between the fund managers and the investors, which most of the time means pensioners. And, this is the reason why, of course, he invented the index fund. This is why, which started off as Bogle's folly and eventually, passive investment now is 35% of the total amount of investment globally. He was trying to push these fees down to zero to resolve this conflict of interest. But what ESG has really been, I think, neglecting is that, there's a lot of focus that's happening on the E and the S, and not enough focus that's happening on the G. So I think that in looking at the governance structures in finance, considering how we can alter these fee structures is an essential component, because once you can change, again, the incentive structures, then you're going to get different outcomes.
Okay, thank you. And Daniela, what's your perspective on fee structures and conflicts this might set up?
Well, I think I agree with what Melanie's saying. And I think this debate is very much alive in terms of the 220 and all of that. And I think, as an investor, in a way, we can invest in a fund that is 220 as long as the fund is very small and you can justify that those fees are covering their costs. The issue that happens is when those funds get gigantic, and then that structure then becomes an extraction from investors, as Melanie says. And I think the best examples of that is to look at our own as a Snowball governance and the model that we used exactly to avoid that. So to begin with, I mentioned a little bit our investment practice and our investment. So I'll talk on three different points. So our investment is non-extractive, our governance is non-extractive, and our operations are non-extractive. And I'll explain those things. So investment meaning that we are looking for solutions and funds and companies that are much beyond what ESG stands for, but it's actually looking for solutions in organizations that are innovating the way of doing business, as well as what their business results in. And we are super serious about the ultimate impact on people and planet. And to that effect, we are quite unique in how we use impact data. So impact data is not just used to due diligence and then to report, but actually actively monitoring the portfolio and supporting our decision making. So that's our investment non-extractive. The second is our governance is non-extractive. And this means that we are owned actually by a non-profit structure. And our mission is aligned with Snowball's, and the mission is locked into the Articles of Association. So there is a total alignment with investors. There's no incentive to sell Snowball to the highest bidder, and all of a sudden someone that will disrupt what we're here to create. And also for the second year in a row, we've been elected as a top 5% of all big corporations for governance globally. And finally,
at the inception, did it come together then as a venture between people who had the same goals? Like, how did that ethos come about? Because often it would be a partner has an idea, they raise capital, they get the buy-in of others, often on the profit motive. How did you kind of coalesce partners who are baking in the good quality governance into what you were setting out to do?
I think it's very interesting. I would ask Rennie to answer that if you prefer. I'm happy to answer, but because Alexander Hoare and Golden Bottle Trust have been a key founder of Snowball. So, so Rennie as partner in Golden Bottle Trust perhaps is better able to say how that all aligned together.
Rennie, please.
I think it was born out of a number of people that had started off by using the impact investment toolkit from around 2009, 2010, the Peterborough Prism bond, some of the very early big issue invest, different vintages of funds. And we're doing it it was looking at, is there a different way of moving from philanthropy to really affecting change? And certainly from Alexander's side, it was that if you really want to do something that is going to make a difference, you need to bring the whole of finance with you, instead of having it as an additive side part of your activities. It has to be central, it has to drive the way that funds flow. And so the thing about Snowball and the partners that coalesced around it, a lot of them were charitable trusts, but they were drawn together to try to prove that there was a better way of doing things, and also that you could move it from it being a side activity in terms of who could participate. So at that moment, it was only really through high net worth individuals or much larger institutional pools of funds. So the mission was, how can we do this to a high enough standard, one that proves it's possible to really have this better way of investing, but two, to do it in a way that you can democratize that access, and you can get more people being able to access really high quality impact investment. So that type of way of approaching the structures you put up, you're starting from a completely different place. You're starting from, what does best in class look like for impact, and that then permeates all the different levels of the way that you're operating.
And absolutely right. So the governance started aligning from the beginning, and in that sense, also just to touch on the point of fees, we operate at cost. So what it means is that the benefits of scale will get translated into lower and lower fees to investors, because they're passed to investors, and that is fundamentally a belief that the investment management is a service that we provide. So we shouldn't be extracting, and we should be well paid for it. That's fine, like everyone else, but not excessively paid for it, which means that exactly because that value comes at the expense of pensioners, foundations, families, and asset owners. So ultimately, you're subsidizing, you're getting everybody to subsidize a group of very wealthy individuals. So that's what rounds up the internal consistency, I think, of the way that we operate, and investors love it, of course.
Is it more costly to operate to be running a sustainable fund, or things that have additional, or is it like any other form of fund management? There's research and due diligence, or do you see extra layers of cost that need to be obviously paid for? I mean, what's your perspective on that, on the cost it takes to run structures this way? Hence, why wealth managers or investment managers are looking to, charge premiums to do so.
Well, it depends. If you're doing it properly, there are extra costs, yes. And the fact that is because we're trying. So, for example, at Snowball, first of all, there's no passive investment in impact. You have to actively manage your portfolio. You have to actively manage those the funds and the companies, because it's still a very new area, and it still requires that constant interaction and intervention in a way. I think the second thing is, yes, we're trying to optimize for risk, return, and impact. So what we're trying to do is to not compromise on risk and return and add a dimension of real impact. And that takes a hell of a lot more of research, of due diligence, and of scrutiny, because you're adding a whole dimension that is beyond looking at just the risks presented by environmental, social, and governance factors. It is actually going into, is this a real solution for some of these issues? And how do we know that? How does it benefit all stakeholders? How do we measure it over time and track? Is that measurable or not? So it's a real, so there is, an additional layer of cost, no doubt. And I think that's why, the people that are all serious about it really want it to be regulated so that we create a more level playing field with the people that are just talking about it from the people that are actually doing it.
Thank you. Melanie, what's your perspective there on costs that are incurred by those going into running these sustainable funds and structures?
Yeah, my perspective is a little different because, running a non-extractive cybersecurity company, which is essentially the same kind of vehicle as Daniela is running, just in a different industry, I find that less extraction is actually a competitive advantage on the market because when you're not bleeding cash from the company, it means you have more cash left to reinvest in R&D, in better quality products and services, in paying your staff better, in lowering the prices, for our customers. So in that sense, I found with a cybersecurity company that actually keeping that value inside the company, is great actually, and doesn't require any additional subsidies or anything to level the playing field, because I personally find the playing field is rather level to begin with. One other thing that I'd like to address that Daniela had touched upon was that she's doing this with active fund management. But I would also like to point out that this can be done with passive fund management as well. Creating not-for-profit investment funds, there are actually surprisingly some really wonderful role models and really great examples. Impact Shares is a great example that was started by the NAACP, which is, the National Association for Colored People. It's an NGO for African Americans in the United States. So what they did is they created a line of ETFs, but this whole vehicle was implemented through 401c3s, so US-based nonprofits. And it was also set up in such a way to, of course, it's already passive, so the funds are low to begin with, but they're ensuring that everything above cost price, both returns as well as fees, are pumped back into the ETF itself. And again, this is it's not just that they're using the ETF then for its proxy votes to then also fight for great things like diversity and inclusion, but it's also that what they're doing is building a self-sustaining vehicle for the NAACP's activism, which is brilliant if you think about it. They also have an ETF for women. They have an ETF for climate. So I would also encourage anyone who's in the finance field and who's thinking of experimenting with non-extractive and not-for-profit finance, that there's so many different ways you can implement this.
And one of the big hurdles, I suppose, getting to a certain point of scale, isn't it? So that so that you can absorb enough costs and be viable. How do you address not niche ideas, but a new idea, bringing new ideas to the market? Obviously, Snowball has tackled that in their own way. It'd be interesting to get a view from Daniela in that in a sec. But what's your view, Melanie, on that, about how people get these things launched?
I think that it's tough for small fund managers and for brand new fund managers. And I think that there's a chasm of, roughly 30, 40 million-ish that a lot of new fund managers kind of get stuck in. Of course, family offices and NGOs can help to launch these funds in the first place and get them started. But at a certain point, institutional investors also need to get on board. Otherwise, things are not going to actually get traction. But the problem, though, as I'm sure many of you are aware, is diversification rules. Because if a pension fund says, okay, that's great, I am going to do a minimum tranche of 100 million, and you need to be, less than 10%. This needs to be less than 10% of your investment, of course, that automatically cuts a lot of new fund managers out, because of course, the BlackRock can snap their fingers and create a fund of 1 billion tomorrow, but a lot of new fund managers cannot. Now, I think this is the role that family offices, multifamily offices, high net worth individuals can very much play, because the more investors we can get at the very beginning, the more we can sort of eventually crowd in, I guess, the larger players. And all we need is just a few really good role models like Snowball, to show, how this is not just theory, but we can actually implement this. And I think once we can get these kinds of funds to the point of viability where the institutional investors do start coming on board, what's not to love for them about this? Because first of all, low fees. Nobody's going to complain about low fees. And the second thing also is you're essentially providing, better risk-adjusted return, because the more you are resolving the conflict of interest between the fees and the investors, as you reduce this conflict of interest, the less risky you're making this whole proposition. So really, I would say all of the different aspects here line up, but it's just a matter of getting that flywheel spinning.
Thanks. And Daniela, what's your perspective on scaling up? Melanie mentioned there the role of family offices as perhaps more nimble players who can kind of take a view. Engaging institutions is fine beyond a certain threshold, but it must be quite a journey at Snowball to get to a point where you're able to carry on up that AUM curve.
Yeah, and I think that's our experience as well, that asset owners are driving the agenda, and they sort of usually take the lead. Not only because they're more nimble, but also because I think they are, in a way, you're getting straight to the investor, with the asset owners. So the problem is the intermediaries usually are laggards, partly because nobody is ever fired for buying IBM. And when you get anything that is new, they usually lag the people who actually can make decisions by themselves. And it's interesting, we're seeing this shifting, because 2 years ago, I think 2-3 years ago, we went talking to various wealth managers, and nobody was interested because they were only looking for ESG funds. And when we talk about, the way that we're looking to solutions and innovation and thinking about actually ways where investments can also further, social equity and environmental sustainability, they said, "Oh no, that's fine. We're looking for, that we have that already," which was their ESG funds. And what we found this year is that they are coming to us and very, very interested in what we have to offer. And the reason for that is not that they had an epiphany, but is actually that the families, their investors, are putting pressure on them to align their investments with their values. I think a lot of ESG funds as well have been unpicked. And when you looked at what's inside, what was sold in the marketing brochure and what was invested in was highly inconsistent. And I think investors have seen that and felt really disheartened by that. And I think people are getting more and more educated, which is normal, something that is normal to happen. From our perspective, our fund more than doubled in the first year that we opened to new investors, and we continue to grow and to perform in line or better than benchmarks, actually. So, and what we try to do and always aim to do is to be very transparent about how we look at impact, what is in our portfolio, which is, the way that we are, that we also scrutinize the ways in which we look at the impact at the company level, the ultimate effect provider of services and products, at the fund manager level, and at our own level. So this year we're going to be audited independently for our impact processes, and we'll make that public as well. And as far as we know, we're the first ones to be doing that.
Fantastic. And Rennie, just to bring you in, are you seeing this sea change that Daniela's saying about clients, asset owners, really, very focused in on this session and actually pushing aside stuff that's got more of a gloss to it and looking for real substance?
I think it's the market's beginning to bifurcate, and you're beginning to get people that are really seeking out impact and realizing that the stuff that they're called impact maybe was just reasonable ESG, and it was looking at risk metrics. It was looking at stuff that was measurable but not particularly useful in terms of actually shifting and changing things. So you do have a group of people that have realized that stuff that they've called impact is not impact, it's ESG classified, and so they're seeking out a Snowball type of solution or a way of doing impact themselves. You do still have a very embedded bit of the market which is talking about ESG as impact, and for me this really worries me, because ESG is just, are you a sufficiently informed investor that you know whether the financial returns will come through or not? And so that means you could have things which perform very badly on an environmental or a social return, but because they're so discounted financially and you've got real visibility on the returns that you'll make financially, you can still make that investment. And that type of ESG really, really worries me, because you'll get a whole group of consumers that haven't gone into the fine print, have not had the chance of sitting in front of the portfolio manager and saying, what's your philosophy, what's your process, how do you make it repeatable? And it begins to strain at the credibility of something that it's not linked to, which is impact. And so the more that you can have standard bearers for what impact is, the intentional environmental and social returns, the better. And making sure that, one, you guard it from ESG and that conflation of what it is, but also on the other side, that you guard it from philanthropy and so those types of operations where you get no financial return at all, but you get some wonderful social or environmental impacts. So for me, this nascent area of impact investment is so critical to defend, because that actually is the thing that you're incubating to be able to change a financial system, that you've got these environmental, social and financial returns baked in. And if you can really capture that and harness it, that's the thing that you want to be able to activate and have sweeping across mainstream markets.
And is that down to professional education as well, and regulators looking at how, portfolios or how client monies are being invested? There's obviously a few years ago on suitability and things like that. There's lots of constraints that financial advisors have to work within. Is that something for this part, or is it educating end consumers on to look a little bit deeper as to how they're invested? Where do you think or a bit of both? What do you think is required to address this as this nascent market develops?
For me, I think that if it was as simple as one solution, it would have been done. And that if you're affecting change and if you're trying to instigate change, you actually need lots of things to line up. One, you have to have the consumer demand, the sufficiently informed consumer to be able to do that. Two, I think you have to have the right level of product sets to be able to fulfill that demand. And then three, I think you do need to have the accommodating regulatory environment. But people who are only looking at the regulator to be able to solve the problems, slightly be careful what you wish for. Equally, if you think you can just do it from informing consumers or only building out the product set, you need to have all of these things working simultaneously. You need to have passionate people in each of those fields really pushing at the forefront of it.
Very interesting. Melanie, what's your perspective on how we can solve some of these major challenges as this market develops?
Yeah, it's interesting that you're speaking about the regulators. I have a kind of funny story. There's an impact VC firm in Amsterdam, and they wanted to launch a fund with a reformed fee structure. And they went to the AFM, which is basically the Dutch financial regulator, and asked, and apparently the AFM came back with the response that, well, but we don't entirely understand, because if you're not using 2 and 20, then what's in it for you guys? Like, there must be something weird going on here. So I mean, I think there's a really large educational component, because until people understand why we're realigning the incentive structures, and then understand that this isn't just some form of fraud or tax evasion that's underlying these movements, and this requires, certainly giving people like Daniela a podium, preferably as often as possible, so we can understand that people are out here doing this. But also just, even on an educational level in business schools, I mean, teaching the next, generation of financial professionals that these two are viable fee structures. It's the same now with Patagonia, with Yvon Chouinard, who just, a few weeks ago decided to sell his company, to basically essentially give it away to a climate foundation. It caught so many off guard, and it's the first time that I've seen steward ownership in the mainstream, to the point that it even created a backlash. I've never seen steward ownership create a backlash before. So just the fact that it got to that place where people are asking, gee, are we sure that, giving away a company of what was it, 2 or 3 billion for 200 million tax savings? Are you sure that's not tax evasion? The fact that we're even getting to this point, I think, is phenomenal, because it's providing these kinds of role models that we need. Now, coming back to regulators, I think the other thing with regulators is they're trying to make sure that consumers are protected, also citizens as a whole are protected. And if you consider what a lot of investment funds are used for, oftentimes much money comes from the government, also pensioners, but we wind up with this problem that the economist Mariana Mazzucato talks about a lot. Her thesis is that she wrote a book called The Entrepreneurial State, and her thesis is that the government is the world's largest VC, which if you think about it, it makes sense, because they're constantly paying for roads and bridges and developing vaccines and fundamental academic research. But the problem that we have is that the costs are being socialized and the benefits are being privatized. However, it doesn't actually have to be this way, because if the government would understand that they too could embrace nonprofit entity forms and steward ownership structures where exits are essentially impossible, then all that's really left is impact. And if you can use non-extractive vehicles, whether it's investment funds or businesses, contractors, either way, what you're ensuring is that the money for all of these government projects is not going into the pockets of a small number of individuals, but rather it's going to pay for fair wages for the employees that are carrying out the work. And then everything else is getting reinvested back into making that project better. So in essence, I mean, this non-extractive finance, but also non-extractive business is in a way almost solving this kind of Mariana Mazzucato problem that we're facing.
And how are you seeing companies, how are we seeing smaller shareholders engaging and sort of setting the tone for positive change? There's many ways now in which that shareholders can express opinions through to companies to be more sustainable, to reflect their own views. I mean, Melanie, have you seen innovation in that area?
Absolutely. I'm extremely heartened by some of the shareholder activist organizations. Most of them do tend to be NGOs. As You Sow, I think, is a really fantastic example. Also, in the UK, you have Share Action. There's many others. But the problem is most of the time they're NGOs that are reliant upon subsidy and donations. This is a weakness, because as long as you have these kinds of uncertain funding streams, you're never really going to be able to grow or scale your initiatives. Now, what I found really brilliant from this past year was engine number one, not just their campaign against ExxonMobil, but their Transform 500 ETF, ticker symbol VOTE, that they implemented after the fact. And what I think is particularly brilliant about it is they took shareholder activism and gave it a business model. And that's the thing. The moment that you give it a solid business model with a solid value proposition, it is building the platform from which such an initiative can then take off. I mean, of course, there will be questions. I mean, how do we exercise the proxy votes at that point? But I think that thinking in terms of maximizing proxy votes rather than maximizing only for returns, I think that that's a very interesting way to ask the question. And I think that also, if you look at As You Sow, they also have another fantastic initiative that's called As You Vote. And what they're doing, first of all, they're providing alternate sources of voting advice for those who want to go move beyond ISS, SRI in terms of proxy voting advice. But also they're using a platform where they're trying to allow institutional investors, but eventually even retail investors, the opportunity to use Broadridge to essentially get a kind of template of proxy voting advice. It could be theirs. It could also be one's from a completely opposing, point of view. It's a neutral platform, but it's sort of similar to. I'm an American citizen, and I sometimes want to vote in local Florida elections, but I've been gone for a while, so I don't really know who all the different politicians are. But what I do know is I can check with certain organizations that fit with my political values, and they provide essentially these little slates of voting advice. And all I have to do is sort of Christmas tree in, who they tell me to, and then I know that I'm going to wind up having supported a platform that fits my values. Now, what As You Vote is doing is they're providing a similar mechanism, neutral platform, but multiple parties can place their advice there, which then, if you enable pass-through of proxy votes to the ultimate beneficiaries, in other words, the pensioners, what they're actually doing is they are bringing true democracy to corporate governance, which is an earthquake. I mean, this is fundamentally transforming everything. And oftentimes the argument against that is, but the citizens, the average people, the average Joe, they don't know enough to be able to vote responsibly. But the point is, as long as you have experts that are putting together those slates of voting advice, they then do have the necessary financial education and can balance then the fiduciary aspects with the ESG aspects or any other aspects in such a way. I mean, it kind of diffuses that excuse, and I think these are developments that I see moving forward in the next decade that really excite me, because I mean, these are things, quite frankly, that we haven't tried, but I mean, this can create seismic waves, in our democracy, in our societies, if we can actually manage to pull this off.
Fantastic, really interesting. Rennie, just coming back to you, so just looking at on the philanthropy piece, and just looking at how within charitable structures monies are invested, what is it that you see there? You're obviously involved as well in Philanthropy Impact, which is a terrific organisation on mobilising philanthropic capital. That should give us a bit of insight as to how you see the two fitting together.
So, I think there's certainly probably over the last 5 to 10 years, a shift from looking just at really well-intentioned philanthropic efforts, and that's where you spend 95% of your time, and then maybe at some trustee meetings you might dust off the quarterly statement that's come through from your investment manager, check that it's sort of roughly maybe even gone up slightly but hasn't gone down too much, and then get back to really focusing on your grant making. And that I think is beginning to really get strained at, the credibility of doing that. One is because you do run the risk of unthinking investments, undoing the good that you're doing with your grant making. So you're focusing on some excellent things where you're changing the situations of particular groups of vulnerable people, or you're doing something fantastic with the environment, but you have investments which are not put towards a similar structure, a similar type of mandate, and could be investing into really extractive, fast fashion labels, or you're going into a whole load of very extractive energy companies, and that completely undoes the good that you're doing with your grant making. So that at the sort of absolute fundamental level has begun begun to make people think, gosh, we can probably do a bit better.
Mm.
When you take it into the reality of the way that a lot of foundations are structured, the need becomes even greater. So possibly 5% of the money that you're operating is through the grants. 95% of it is through your investments. So this situation where you're being unthinking and that there could be problems is writ large. But instead of focusing on the negative, it's far better to envisage it in the positive way of how can you take this far bigger pool of assets and make it a real strength, real addition to what you're seeking to achieve. And we've seen some quite interesting developments in this space. So one is there are a number of foundations that have moved to having all of their investments into impact investments. So straight away you are mobilizing both of your activities, your grant making and your investments. But the development is coming even further, and where we're talking about fast moving areas, the measurement of impact, the bringing it all into one plane is seeming to really have struck a chord and really caught people's imagination. So people are using the Sustainable Development Goals to badge up both their grant making and their investments. So in one place you can see something called total portfolio impact. So where both of your activities come together and the things that you try to solve. Once you've seen it in one place like that, it actually makes you realize that there are different vehicles, there are different things which are either accessible through grants or through investments. So if you're looking at SDG 17, partnerships for the goals, which is the things that removes the blockers for the rest of the 16 other SDGs, that's very, very difficult to invest into. But with targeted grant making, actually you can make a massive difference. Similarly, if you're looking around climate action, there are some great environmental charities that you can go after, and they're removing some of the barriers, but there's a whole suite of incredibly developed investment tools that you can go through. And so you can start being much smarter with how do you allocate your funds? What are the right tools to bring to bear? And by looking at grants and investments in one place, actually you can really do much more clever things by using all of your assets rather than just a sliver of the power that you've got.
Thank you, Rennie. Really, really interesting. And Daniela, just to bring you back in, I mean, I imagine the charitable sector, the foundations that Rennie was referring to, is a big customer base for you. But how do you see that, the philanthropy and impact piece coming together?
I think, as Rennie said, I mean, I think it's an increasing trend, definitely. And I think sort of foundations are waking up to the fact that if they have 90% of their resources being invested in financial markets, and the other, 5 to 10% are the resources that actually are granted away, it makes no sense to just focus on actually their business is investment, right? And then grant making is almost a side business. So it's kind of, I think it's almost flipping the awareness. I think it's still early days, but I think it's beginning to change. But I think that's kind of how foundations should start to look at themselves in the way that Rennie mentioned.
And one of the big debates going on amongst trustees in places like the Channel Islands and further afield is trustees being allowed to make investments in the impact space, and that they don't open themselves up to risk from future beneficiaries who look at the returns that have been delivered. I mean, Daniela, do you see offshore, do you engage with trustees on mandates, and are you being invited to more beauty parades to kind of pitch your services, as it were, in a way that trustees are buying into the impact piece much more readily? It still seems an open discussion when I speak to people around the world.
It is interesting. I mean, you're right. It varies quite a lot depending on where you are in the world. I mean, I don't know if you're aware of what happened in the UK with the Butler's Loss case that they won legally as to trustees having the ability and almost the obligation to sort of consider other factors in their investment that are not just financial returns. So I think that the Charity Commission has advised it in the UK, and this case kind of cements it, I think. In other parts of the world, it varies quite a bit in how people see it. I think the confusion between ESG and impact also is unhelpful in that regard, because I think a lot of trustees, and again, partly also how boards are composed and diversity on board, like all of this comes together to kind of, what kind of trustees that are willing to sort of look into this in a more progressive and in a way that, and I don't mean progressive politically, but in a sense of this is a relatively new market. And, you have to embrace the fact that we don't have 100 years of financial data to back the performance of impact investing. So you have to have trustees that have the confidence to look at a smaller data sample and a smaller period of evidence, but who have that willingness to basically say, wow, wouldn't this be the best possible solution to do? And how do we get around that? And I think that is the mindset that when we see foundations that engage, and we have a lot of foundations that have invested in Snowball, usually we see the mindset is one of saying, wow, this is amazing. How can we make this work? And inevitably they make it work. Versus looking at this and say, I don't know how to make it work, so let's not even look at it. And I think it depends a lot on who the trustees are. That's what we've seen in terms of our own practical experience. And I think that's why sort of, when we talk about I guess, regulation, but also clarity. The fact that in the UK now you have the sort of the court case and you have the Charity Commission guidelines, that makes that kind of excuse in a way less palatable and less plausible. So you kind of like, if you feel that surely, of course you have to look at track record, you have to look at lots of different things, but to say that, oh no, it's my fiduciary duty and I can't touch anything that is not just financial returns, that at least with the clarity of guidelines, with the clarity of a court case, then you have that North Star for trustees. I think in other jurisdictions, you still kind of hide behind that cloak of fiduciary duty, which again, it's sort of, if you think more broadly as to what it means, you should be taking into account, environmental and social factors, because actually you're acting on the behalf of future value creation. And those costs exist, and they will have to be paid by someone if you damage the environment, if you destroy social capital, basically.
Very interesting. There is a question from YouTube. I'm going to put this back to you, Daniela. Just to say, would you like to see the charitable sector's investment strategies coming under closer focus? I mean, you mentioned that the Charity Commission sets out, guidelines there for charities as to how charitable monies should be run. But you don't want to create burden on charity, which is trying to do good. I mean, how do you see, should there be more scrutiny though on charities? Do you think in how they invest? I
think there is enough scrutiny in terms of how charities invest. I think what it should be is more encouragement and incentive. So it's almost like the carrot and the stick. Which one do you need to use? And I'm always in favor of both. Because I think if you only say, oh, let's just encourage, let's just incentivize, it takes a long time. And then we continue sort of with the old practices. I think if you only use the stick, you run the risk of paralyzing a sector. So I think it has to be a little bit of both, both there, not just the charity sector. I think sort of in general that is something that we should always think about when we're trying to balance when we're trying to balance those two imperatives. So the imperative of creating positive outcomes for environment and society, and the imperative of creating financial returns, because you can't jeopardize one or the other.
I mean, Rennie, do you have a perspective on scrutiny on charities on their investment strategy? Are they scrutinized enough? Daniela said they're carrot and stick. What's your perspective?
I think the position that we've got to is that people have to write down and say why the way that they're investing is not causing harm, and this is why it's all right to be able to invest this way. My desire with you inverted. How can you have any charitable funds that are invested, and you should be able to explain that this is why it is here and this is the good that it's doing, and if there's any deviation from that, that's what you need to explain. These funds, as soon as they're inside a charitable foundation, are there for public good, and so to explain why you need to have a change of the model where if you don't have these invested into impact investments, into the very best things for achieving social environmental good, that's when you should have to explain as a board of trustees. And I think this bit of policing around the edge to make sure that people have explained why it's okay to invest in a way that does good is just bonkers. So I would say that we need to get to quite a different position on the way that we operate.
Thank you for that. And just as we're coming up to the end of this hour, I'm going to come to each of the panelists for just some closing comments, thoughts, things to leave the audience with. I mean, Melanie, perhaps I'll come to you first. We've covered a lot of ground in this last hour. It's been a really interesting conversation. You've provided us with so much food for thought. Did you have any closing comments or thoughts?
Absolutely. So I agree with both Rennie and Daniela. I think that non-extractive finance and also non-extractive business is the ultimate catalytic philanthropy. It ensures that the work that is done has a solid financial basis for persisting, which of course is the problem with most grants. Of course, the projects disappear once the funding runs out, but also by the non-extractive nature, by, again, the use of these non-profit entity forms, steward ownership models to prevent exits and perverse incentives down the road. This pulls out the greenwashing. As we move forward, we need to be extremely concerned about how do we realign the incentives, how do we pull the greenwashing out of our impact. And I think that continuing to give a platform to such wonderful role models, such as Daniela, but also others, we need to cultivate this industry, create more pioneers, and it's just crossing the chasm. It starts with the early adopters, and very slowly gets to that chasm where it crosses into the mainstream. And that's the way it has to go. And of course, in the end, the laggards will come along, but only because they're running, because they don't want to be left behind.
Thank you, Melanie. And Daniela, any closing comments or thoughts as we come to the end of this hour?
Yes, I think the way that we should, I think the idea that we, in a way, I kind of think that, sorry, I'm getting lost.
That's all right.
In a way, I think what's going to happen to the investment industry is something similar to what happened with, smoking in planes. It's something inconceivable that we used to be able to smoke in planes, and I think at some point in the near future, hopefully, people are going to look behind and say, how can we possibly have any other way of investing that doesn't account for all the costs that are included in this, which means that internalizes what today are called the externalities, but actually are the impact on people and planet of the productive activity. So what impact investing does is actually bring that into the equation and really understand how do we move into better models, into things that are positively impacting, society and the planet. And so I think the future, this is not a niche. I think this is a way that the whole industry is progressing and should progress. And I think the challenge for all of us that are interested in this is how do we accelerate that movement? And and just to finalize, like Rennie touched on, I think it's a combination of various factors. It's not one-sided. There is a legal element to it. There is a regulatory element to it. There is a consumer element to it. There is an education element to it. There's a practitioner element to it. There's a policy element to it. And all of those things. And there is a lot of this already bubbling and happening. So it's not starting from scratch, but it's kind of how they will all galvanize together, a little bit like technology. It starts, it starts very, 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 it takes forever, and then it exponentially goes and becomes ubiquitous and cheap and democratized.
Thank you, Daniela. Rennie, are we at that inflection point right now? Are we close, or are we're still building towards that point, as Daniela says, where we can accelerate all these trends that we want to see?
I think we're at a nascent stage, and actually this is the point that I'd like to make, which is around the protection of true impact. And so if people are wanting to go into that area, making sure that they're very sure of, this is ESG, this is stuff that's just risk management. This stuff is philanthropy. We're getting no return from it. It's a wonderful thing to be involved with, but it's not investment in terms of impact investment. But there is this thin sliver of stuff that is possible, even right now with the vehicles that are out there, where you're getting those intentional environmental social returns and the financial returns. And with that, the fact that there are track records out there, that it is possible, if people want to make that first step, actually it's an incredibly open space. What you'll find is that people who are operating in it are so willing to give their time, their expertise to help you take that first step. So if it is something that you want to get to, don't feel that you need to travel that journey alone. There are other people out there who'd be very happy to help you get going.
Terrific. Well, look, thank you for joining me today. It's been a wonderful discussion. Thank you for tuning in, and I wish you a very pleasant afternoon.